So this is 15-11. We're going to basically use some information about ratios to reconstruct items from this income statement. So what do we know? We know that the inventory turnover ratio was 4.7, and it gives us some information on the beginning and ending inventory balances. And we know the profit margin is 0.16 or 16%. So let's try to find out how we can fill in these blanks here. So I think the first most obvious thing is the profit margin ratio. That's the simplest thing to calculate. So basically we know that the profit margin ratio is equal to the net income divided by net sales. So we basically can have our formula here, net income divided by net sales is equal to 0.16. This is not the most straightforward visual representation, but just follow me verbally. So what do we have here? We know net sales is 7,300. So we basically maybe let's do it like this. So profit margin equals net income divided by net sales. So just using our knowledge of rearranging terms in an equation, if we multiply net sales by both sides of this, we get net income equals net sales times the profit margin. So we can calculate net income by basically taking our net sales and multiplying by this factor. So our net income is 1,168 based on this ratio. And once we know that, we can calculate this income tax expense because we know the income before taxes and we know the net income. So the difference is the amount of tax that we paid. So 1,325 minus 1,168, $157. Okay, so now we're gonna have to use the other ratio to figure out the rest of this. So cost of goods sold is related to the inventory turnover. So let's write out what the equation is for inventory turnover. Basically, we know that the inventory turnover ratio is so inventory turnover ratio is equal to cost of goods sold divided by average inventory. So in this equation, we know two of these three things. We know average inventory and we know inventory turnover ratio. So we can use it to calculate our cost of goods sold. Again, by multiplying both sides of this equation by average inventory, it cancels out with this denominator here. So we get cost of goods sold on its own is equal to inventory turnover ratio times average inventory. So this is the same thing as inventory turnover so these two are equivalent equations. So now let's fill in the blanks. So we have our inventory turnover ratio is 4.7. Our average inventory is just the average of 750 and 710. And so when we multiply these together, this is our cost of goods sold. Okay, so now we can do some basic algebra to figure out what this interest expense is, because we know all these numbers, including this side of the equation, income before income tax. And so let's see what we need to do. It's basically net sales minus all your expenses equals this income before taxes. So 7,300 minus 3,431 plus 1,700 plus X. Let's just leave that aside. Plus 135. And if we subtract this, so I did kind of the algebra in my head, but let's just prove that this is correct. So we have 7,300 minus 3,431 minus So what I did here is I basically took the net sales and I subtracted all the expenses. And now we're going to expect that to equal 1,325. And so it does. So these numbers all seem to flow together. And so let's check our answer. And yes, it's correct.